And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it is Wednesday. That means that Danny Ratliff is joining me this morning. We're going to do live Q&A today, so whatever questions you have, we'll certainly talk about those. I've also got a few other topics to get into this morning. Some interesting kind of conversations on Twitter yesterday revolving a chart. We'll kind of get into that this morning. But again, Twitter's always X, whatever. It's always a fun environment, right? You get kind of get the crazies going.
Rich with content.
You know, which is funny because I just post stuff just to get people riled up. I mean, just
let's rev them up now.
I know, right? What they don't get is that the more engagement there is, the better it drives the metrics.
Exactly.
So, exactly right. So a little bit of engagement. I love that. So anyway, a few things this morning. More bank earnings out. We had JP Morgan out yesterday. One of the things that we've talked about previously is, it was interesting. I made a comment a while back about how QE winds up into the financial markets and got a lot of pushback. It's like, no, that doesn't, QE doesn't wind up. It doesn't do that. How does it get into the financial markets? Well, it goes through the loans and the banks. The banks then take QE and they loan it out to hedge funds, prop trading desks, etc. And this is why when you take a look at earnings, what's the one thing driving earnings for these major banks? Trading revenue. Bank of America reported this morning better than expected earnings on the back of what? Better trading revenue. That's how they make their money. So again, it's just always interesting that there's this kind of big denial about how money operates in the system. But again, these banks are, Bank of America, JP Morgan, Goldman Sachs, BlackRock, these companies make billions of dollars trading markets through liquidity that they can access through repos. So anyway, that's kind of the function that's going on right now. Financials were under a little bit of pressure yesterday because of JP Morgan's announcements this morning. Futures are pointing just a smidge lower here. Yields are down as well. So again, just the market's kind of going through this digestion phase right now and just really hasn't kind of worked its way out of that just yet. Now, today, news yesterday, of course, CPI came in weaker than expected. As we talked about yesterday morning, the kind of Morgan Stanley, those guys were expecting somewhere between 0.35 and 0.45% print on CPI yesterday morning. It came in basically on the screws at about 0.2. 0.3 on the headline, 0.2 on the core. So CPI is maintaining around 2.7 right now, still kind of working its way lower. CPI was weaker yesterday. That worked well for yields. Bonds did okay. Fed rate cut, the number of expected Fed rate cuts picked up quite sharply for this year. Again, slower inflation. The Fed can continue to cut rates. Interestingly enough, though, that data, didn't really feed into the markets. Markets were kind of weak yesterday. Again, there were some spots of green. Energy did well yesterday. Google did well yesterday, but good bit of red. Financials, technology in general was a little bit lower yesterday. Despite that news, you would expect that news to really drive the markets. Now today, we're going to have retail sales, and we've got a whole lot of economic data from retail sales and other stuff today. So there's going to be a lot of data out this morning that will potentially move this market one direction or the other. But again, the markets are going to open a little bit weaker this morning. And as we've talked about, here just recently, the markets have just been really kind of consolidating this trend. And that kind of brings us to kind of where we are this morning. And here's what you need to know before the bell. Again, markets did decline just a smidge yesterday, coming off of all-time highs. So again, this isn't negative, by the way, or bearish by any stretch of the imagination. But the thing to kind of pay attention to is that we are starting to really kind of define a narrowing channel in the market. So we've got this nice kind of rising bottom here, but then also we've kind of got this confining top. So again, we're starting to compress price here. That wasn't a very good line. We're starting to compress price here. So the market is going to break out of this trading range here sooner than later. And this kind of compression of price is as we've talked about before, is kind of like coiling a spring. So you're going to get a pushback at some point when this market breaks out. So if it breaks out to the downside, we could expect a decent, decline, maybe down to the 100-day moving average, which is around 6,700. Break out to the upside, you're going to get a move up towards 7,100. So we'll see where this breaks out. My kind of suspicion right now is that we're likely going to see a little bit of a pullback here in the markets over the course of the next 2 to 4 weeks here. So kind of a break to the downside may not really be surprising. Now you're going to need some catalyst for that, and I don't know what that catalyst would be, but that's just kind of the inkling I've got in the back of my neck right now. So again, it's just that's kind of the worry I've got at the moment. If you kind of look at how market breadth has been lately, there's a good bit of weakness kind of picking up across the board. Again, I could be entirely wrong and this market breaks to the upside and just takes off running. It could certainly do that. But again, I just kind of have this inkling that we may see a bit of a volatility pick up here in the last, kind of last week of January, maybe the first part of February. Once, particularly as we get past earnings, I think the market may kind of start to sniff things out. But again, don't make any, just because I said that, don't go make any, big transaction decisions and, start reducing risk. We're not reducing risk on this. Again, it's just a feeling I have right now. But what I need to see is some of the price action to actually confirm that feeling. Because again, if the price action goes the other way, then, our position will change and we'll just stay where we are. But again, just, we are a little bit overbought on a relative strength basis. Momentum is doing fine, but again, it's not really stretched, but we're in a good position on momentum. But again, just some of the general rotations of the market have actually been kind of kicking into place. We talked about on January the 8th that staples were very, very oversold. And since then, staples have had their best run since really April of last year. So we've seen some of that rotation in the market, some of that move from growth over to defense. We've seen that kind of rotation in the market. That's good. We had positioned for that previously. But again, is this an early signal of a move, kind of a risk-off rotation in the market, or is it just a short-term rotation? That's what we don't know yet. We're going to have to wait and figure that out. So again, just pay attention to hear what's going on with this price. But this compression in price, this consolidation, is going to lead to a move in one direction or the other. It's just a function of time until it happens. But again, when it occurs, we'll certainly update you here on the show and let you know kind of what to do next. But anyway, that's what you need to know before the bell this morning. We're going to come back. We're going to talk about a little bit about this chart that I posted yesterday and some of the pushback on that, because it's just an interesting concept about portfolio management. And then we'll take your questions and comments here as well on the show with Danny Ratliff. So don't go away. We'll be right back.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
What's the future of investing in 2026? Gain insights on how AI, technology, and the economy will shape your money in the year ahead at the RIA Economics Summit, January 17th at the Royal Sonesta Houston Galleria. Join Lance Roberts, Michael Leibowitz, and Thoughtful Money's Adam Taggart, plus top minds in AI, crypto, and retirement strategy for a powerful look at the markets of tomorrow. Seats are limited. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Sorry, I'm having technical difficulties over here. Got it all worked out. So, all right, good morning. Welcome to the show. Danny, how are you?
Good. Great.
How are you? Good. Turn on your mic there. It'd be great. It
would be better.
That's all right. So I said yesterday that, or I said a minute ago that I posted this chart yesterday. I just want to show you this chart real quick. So this is a chart of the Dow Jones going back 125 years. And right now, the markets are pushing up on that top end of this kind of long-term rising trend line. Now, just from a technical perspective, that type of action is something you want to pay attention to, because then these are kind of major resistance points over time for the markets. And particularly when you combine that with high valuations, those type of things, it's something worth at least noting that, we've been in a very, very long stretch of this market rally. We've got a compression in price, and markets are pushing up on this long-term resistance. Now that's this is simply, now this means nothing, right? This is a monthly chart going back 125 years. It means nothing today, tomorrow, next week, next month. So you don't take anything like this and go immediately, it's like, oh my gosh, I've got to get out of the markets entirely. But this is always the interesting thing. So I just posted, all I posted was, this is all I said. I said, the 125-year-old trend line, everyone is max bullish at the resistance trend line. And that's very true. That's the way it always is. You go back to 1929, we're max bullish at the trend line. Go back to 2000, you're max bullish at the trend line. 2008, you're max bullish. 2021, you're max bullish. So again, you're going to have these corrections off of resistance. That's why it's called resistance. Here's the interesting aspect. So, a guy responds, he says, I've seen this retarded shit so many times at this point that it's hard to keep track. I used to believe it years ago and it kept me out of the markets. Missed untold gains from that, never again. And he goes on to say that basically that you should mute anybody. If you've got a 20-year horizon, you should mute anybody that posts stuff like this. Okay. I agree, right? You should not use this chart to get out of the markets and worry about, oh my gosh, we're going to have this major correction, because corrections don't happen that way. They don't happen tomorrow. You're not going to wake up tomorrow and the market's going to have this big correction. The point is to understand that these dynamics exist so you can manage risk better in your portfolio. And this goes with any asset class. It goes with precious metals. It goes with Bitcoin. It goes with small cap stocks, mid cap stocks, international emerging markets. Everything has resistance points that eventually are going to break and you're going to have a reversal to the mean. That's why reversions to the mean are the most powerful force in investing over time. And you have to respect that because they're going to occur. So again, but it doesn't mean today, it doesn't mean tomorrow, next week, next month, even this year. It could be next year, it could be 2 years from now, it could be a whole variety of things. But it's worth paying attention to. But here's the interesting thing. So if you have 20 years, don't pay attention. If you have 20 years to your time horizon, don't pay attention to anything like this. Here's the problem with that statement. Let's assume this is 1999 and you disregard that statement. It was 17 years before you actually technically 13 years before you actually even broke even on an inflation-adjusted basis. So great, you got a 20-year time horizon. You spend 13 years going nowhere out of your 20. So now you have 7 years left on your time horizon to get to your retirement goal. You didn't make it, right? Go back to the 60s and the 70s. You spent nearly 20 years going nowhere, ups and downs, and going nowhere for almost 20 years. There are three periods in history where you had 20-year returns on an inflation-adjusted basis that were negative. So the point about this is that don't dismiss these types of data points entirely out of hand and just assume that somebody's calling for a crash. I'm not calling for a crash at all. But what this does suggest, when you combine this type of analysis with high valuations, with what's going on economically, financially, et cetera, you're looking at a period of returns that could be substantially lower than you're used to and keep you short of your investment goals and time horizons. So it's just always interesting that, there's such a vile kind of response narrative to, anything on social media, et cetera, by uneducated people that don't know financial history. But again, we've developed this over the course of the last 10, 15 years in particular because of zero interest rates, massive monetary accommodations, a market that's been, as we talked about yesterday, we've had a market that's generated 50% above average long-term returns. That's generated this whole environment of, just buy and hold an index. It's just fine because it's going to go up over time. You're always going to make money. And the people that are promoting most of this have not actually ever been through a bear market. There's a bunch of commentators out there that started their careers in 2010, 11, 12. They've never actually been through a real bear market where you actually have devastating losses in portfolios. That's something that's a lesson that is taught, and consequences are learned, and investment behaviors change after those types of events. Anyway, just wanted to kind of bring that to your attention. Anyway, good morning, Danny. How are you?
Good morning. But I think you bring up a lot of really good points there. And I think that when you go back to that chart, or any chart for that matter, most people are going to show these long-term trends. Look, the market always goes up over the last 100 years. But as Blair mentioned in the chat on YouTube, not everybody has 100 years, right? We have a very finite time. And that's why, you need to think about how you're allocated, how you're invested. What does that mean for you with these larger drops? Can your portfolio sustain that? And are you going to be able to continue your distributions to meet the ultimate goal for all these funds should not be, number one, to beat the benchmark. It should be to reach all of your goals and objectives. So always keep that in mind as you're managing your own funds, or you have somebody doing that for you. Understand the drawback to these declines in markets.
Right. So, all right, well, let's get to some questions this morning. Danny, I was rambling that you get I'm trying to scan back down and pick up on questions.
I was listening so intently to you, Lance. We don't have any. I'm kidding. So we did have a great question. So Scott retired. Congrats. Wanted to know, can I continue?
Don't retire, Scott. Go back to work.
Yeah.
That is the new trend. The trend of retirees is to go back to work. There's no fun in retirement.
Don't tell him that. Let him figure it out on his own.
Congrats,
Scott. We'll talk about that this weekend. So for all of you also who are coming this weekend to the summit, we really look forward to meeting you all. Sounds like a lot of you will be here. So,
by the way, we do have a very few tickets left. We're pretty close to standing room only, but if you want to come, there's still a few tickets left to get. Yeah. Go ahead.
So Scott asked, hey, if I'm retired, can I still contribute to a Roth IRA? And while that would be nice if you have the funds available, a couple things, we talked about this a week or so ago. Somebody had a really good question on this. But number one, you have to have earned income. So if you have rental income, pension income, Social Security, those, or interest dividends, those do not count as earned income. So unfortunately, you're going to have some type of wages coming in, W-2, 1099, to contribute to that Roth. Now, you could do a Roth conversion. This may be a really good time to look at your assets, the income that you do have coming in, and think about, is there an opportunity? And there's a lot of reasons why Roth conversion may be beneficial. Number one, if you don't have the income coming in before Social Security, he alluded he had not taken it quite yet. There may be a nice window here that you're going to be able to go ahead and reduce what you're going to have to take for a required minimum distribution later down the road. And also, if you have legacy intent, this can be a really nice way to give your heirs funds without them having that new rule of that 10-year period they must make those withdrawals when you pass. So lots of things to unpack there, but ultimately you have to have earned income to do that Roth contribution, or traditional IRA for that matter.
But again, look, these days people are retiring and they're picking up part-time jobs just for that reason.
No, they are. Yeah.
I mean, you can only contribute what is it, $7,000 this year? What's the max Roth contribution?
This year, that max contribution is going to be $7,500.
There you go.
If you're over 50, you've got an $1,100 catch up.
There you go. So, but to make $8,000, $9,000 in a year on a part-time gig, that's not hard.
Well, Lance, we're seeing a lot of people who are going back and doing side gigs or just contract work actually for what they were doing previously for a couple of reasons. Number one, either for healthcare benefits if you're retired before 65. That's a huge expense. In fact, that's one of the larger ones that we see for many people is just health insurance is so stinking high now.
Yeah.
The other caveat, just like you mentioned, contribute, or the ability to continue to contribute. The other one would be obviously is just to make ends meet, have your funds, give them a little bit more longevity before you make withdrawals. All those little things can help.
Yeah, no, and I was teasing Scott earlier, but there was actually a really neat graph out the other day that the number of retirees that are actually just going into retirement and staying retired is falling off sharply. There's a huge resurgence of people that have retired from their job going back to work simply to pick up health insurance, right? Being able to contribute to retirement plans, whatever. But also they're just
bored sitting at home.
Well,
they
that's right.
They need some purpose.
And I think that's the one thing that many people discount or don't take into consideration is you go to retire where everybody knows the numbers. But once you get there, you're like, oh, shoot, what am I going to do? That sense of purpose is gone. The deadlines are gone. The value that you provided, that human capital aspect has been diminished. And now if you don't have a plan, you're like, oh, man, what am I going to do? So many people fumble through it. We call it the crossover risk or the black hole. But if you're prepared and you know going into it, hey, I've got grandkids, I've got purpose here, I've got charity or time I'm going to spend doing certain activities and hobbies, many times those are the most successful people. But when you don't, or, like you mentioned, sometimes you just want to get back in the mix, and understandable.
Yeah, exactly. We had a question here that says, does our SimpleVisor app send alerts? Yes. Whenever we place a trade, so the way it works is the models that are on the SimpleVisor application are the exact same models that we run in-house. So, and in fact, you can open an account through SimpleVisor and we can manage the account for you. So it's a very simple process. But yes, if you're trying to mimic our trades, we trade for our clients first, then we post the trade on SimpleVisor, and then you get an immediate alert both by email and by text message. So yes, the answer to your question is yes, we alert you as we make trades so that you can trade along with us.
All right. So another one, how do you determine percentage of asset to own, thus how much to sell when taking profits? I think this is a great question, and there's no simple answer either, though.
No, a lot of it's, there's a bit of it that's subjective, but we wrote an article. If you go to realinvestmentadvice.com and in the upper left-hand corner, type in portfolio management, we wrote an article maybe a couple of months ago talking about portfolio management and risk sizing, how to build a position risk size in your portfolio. And so you have to understand is that when you're putting a position in your portfolio, just kind of in simplistic terms, if I'm going to buy a highly volatile asset of some sort, something that goes up and down with a lot of volatility, I've got to be willing to withstand that volatility within the portfolio. So if I put a 10% position of a stock in my portfolio that's highly volatile, then that's going to take my whole portfolio up and down a whole lot. So, emotionally, can I withstand that type of volatility? And volatility is fine when it's going up, right? Gold's going up or silver's going up. Everybody's happy. You're not so happy when that volatility reverses and goes in the other direction. And that's what leads to bad financial decisions over time. So risk management is a very key part of this in terms of being able, it's not about making money, it's about surviving the long term so that your portfolio can compound returns over time. So when you think about a position, you're going to buy a position, say, okay, if I'm going to put X percentage in my portfolio, and just the way for you to think about it is if I put 5% of NVIDIA in my portfolio, as an example, and it goes to zero tomorrow, what does that do to my portfolio? Think about it that way. If something would go to zero, how would that impact your net worth, your financial outcomes, those type of things? If, in a $10 million account, a 5% position may be negligible. You may say, yeah, if it goes to zero, I've lost 5% of $10 million. That's $500,000, but I still got $9.5 million. I'm okay, right? But if I've got a 5% position in a $100,000 account, that's a little bit of a different story. And that may really set you back financially in terms of getting towards your goals, those type of things. So when you can figure out what that risk tolerance is for yourself, and it's different for everybody, like Danny said, it's a bit complicated because it's different for everybody. But when you start to figure out what that risk tolerance is for you and how much you can handle that volatility risk, and can I take a position that's 10 or 15% of my portfolio and watch it go to zero and be okay? Then you can start saying, okay, here's my max position size. My max position size is 5%, 2%, 3%, whatever it is. And it will vary depending on the position because of the volatility. So again, if I have a very low volatility position in my portfolio, something that just doesn't go up and down much, then I can have a bigger position in that because it won't impact the beta of my portfolio. But If I have a very volatile position, I may own less of that. I may own 2.5% of NVIDIA, but 5% of, say, something like ExxonMobil. Just picking two stocks, right? So once you figure out your max position size, then it becomes a very simple process. When that position size becomes, I've got 2.5% position in NVIDIA, it's now 4% because it's had a huge run. I trim it back to 2.5. When that position starts to correct, this is the mistake that people make. We now go through a correction in the markets, and their inclination is I've got to sell. NVIDIA's not doing well right now. I've got to sell it all and get out of it, and not have that position in my portfolio because it's going down. That's the other mistake. No, you take your 2.5% position, you reduce it to 1, and then as that position goes through its corrective cycle, you're looking for the opportunity to take it back to target weight. So once you can understand what your target weighted allocations are, you overweight and underweight those positions relative to what's happening in the markets to control your risk, but you don't exit positions entirely unless they're broken, right? So if something's broken, then you get out of it entirely. But outside of that, all you're doing is managing your risk position sizing. But again, we go through all of that in this article on the website. So if you go to realinvestmentadvice.com and just click on the link at the top, there's a search bar to say portfolio management. You'll come up with the entire article that goes through. I've got the math in there about how to actually risk position size in your portfolio.
All right, another really good question here. Thoughts on Trump's newly proposed policy of allowing 401k, 403bs, other investment account money to be used penalty-free for a down payment on a house?
No.
Absolutely not. And so we talk about this often. Currently, and so what this is alluding to is that right now, first-time home buyers can take up to $10,000 for a down payment on a home penalty-free. Here's the problem with this, is that we continue to allow individuals, all of us, to access these funds that are really set for one thing, and that's retirement. So we like to call it leakage. There's lots of leakage, loopholes that they allow us to take this money out. But what are these funds intended for? They're for retirement. They're not for that down payment. And so unfortunately, we forgot the personal finance 101, just those guardrails. What should we be putting aside? How should we be allocating funds? Save your money for a down payment. I get it. Yes, I know things are very expensive. Many people are struggling just to find a home they can afford. But how did all this happen? Leverage.
Well, we did all these things, right? Zero interest rates,
correct.
No money down for mortgages,
split
mortgages,
down.
Adjustable rate mortgages.
That's what I'm saying. Get back to the basics.
Right. And this is what I'm saying. Like Trump did a really good thing recently. He said, we're going to get corporations out of home ownership. Awesome. Great. Perfect. Great first step. Applaud you for that. Then he turns right around and negates that whole thing by now providing incentive to go buy a house. So I'm going to spend $30 billion buying back mortgage-backed securities, right?
Mm-hmm.
We're going to start buying mortgage bonds back. We're going to drop interest rates. Great. That increases demand. That helps support the price. And we have supply is dropping on the market. The number of homes being built right now because of the lack of demand is declining. So you induce demand through allowing you to tap into 401ks or whatever to go buy a house is sounds like a great idea, but all you're going to do is drive unaffordability higher. You exacerbate the problem. Stop. You've got to reduce the demand. If you want to fix the unaffordability problem, you've got to reduce demand in the economy for housing. You do that by raising the minimum down payment to 20%. It's interesting. I saw an article the other day says, the reason that housings are unaffordable is because mortgages are 6%. I would have killed for a 6% mortgage back in the 90s. 6% is not a high mortgage rate. That is a normal mortgage rate. That is what mortgage rates probably should be. If I'm loaning money to somebody for 30 years, I probably would want a 6% yield on that loan to make sure that my loan dollars are outpacing inflation and giving me some opportunity over time. So a 6% mortgage rate is not high. The problem is the supply-demand imbalance, which is causing prices to remain high, remain elevated. because of all these other incentives that you're applying to the market. Incentives create the problem. Reduce the incentives, you fix your housing problem. Yes, and it's going to absolutely suck for a while. Nobody's going to be able to afford a house at all, period. That's a good thing, because now home prices will start to fall, because you will find that the prices will return to equilibrium of supply and demand in the markets. So you've got to stop all of this stuff that we've been doing for 20 years. 20 years of all these incentives and trying to get people into houses they can't afford is ridiculous, and has caused this problem. Here's the other thing. Let's get people into a house. Awesome, right? Great. You've now taken out your 401k plan and you've bought a house. You never own your house. You never own your house, period, because you're going to pay property taxes on that house the rest of your life, and you miss a property tax payment, you lose your house. You don't own your house.
Had that conversation with the kids the other day.
Yeah. So now you've taken out your 401k plan, you've got no money for retirement to live on, but you've got a house that you still got to pay expensive maintenance, upkeep, and taxes on for the rest of your life. So now you're great, you're asset rich, you own a house, but you're financially poor and struggling to make ends meet. That's not retirement. Okay, well, I'll stop ranting.
Yeah, but I think you're doing two things there. I mean, number one, you're taking something that does provide liquidity. If you had to access it, you could. We don't want that. Be very, very clear. If you are...
Oh, so you're going to more debt.
Well, that's right.
To get to your liquidity.
But
this
what
makes
I'm
a lot of
to,
sense as well.
No,
yes.
Yeah. But you're taking a liquid asset to a hard asset that if you do need it, you have an emergency, you're probably not going to go out and be able to get a line of credit or a loan against it because, when do you need it? Well, when you don't have a job, when there's a problem. Mm-hmm. And so we're skipping so many steps here. Number one, create that emergency fund. Number two, save for that objective, the home. Yes. Hey, guess what? Not everybody needs to own a home. I'm sorry. I know that goes against everything everyone is saying. But the average person stays in a home for 7 years. So what are we doing the majority of that time, especially if we're not putting down a down payment? We're paying primarily interest. Therefore, if you're not putting down a down payment, that's when you can get people upside down depending on what the market does. I know we haven't seen that in a while, but it will happen. So those are the problems with housing in general. So giving people access to these funds and making it easier is not a good thing, because now you may own this home, but guess what? Going back to what Lance said, well, you never really own it. You're paying your property taxes. Well, now you just kind of robbed Peter to pay Paul, and you don't have, Peter being your retirement. Guess what? At some point, that human capital does diminish. It does run out, and you're going to need some liquidity.
Yeah.
That's the point.
Well, again, it's just, look, this whole home thing was pushed by the National Association of Realtors.
Of course.
And they lobbied the government for adjustable rate mortgages and split mortgages and all this other stuff. That was back in the late 90s. And, this is why you see all these ads on television about, you need to own a home. Everybody should own a home. Everybody should be. It's great for the real estate industry because they lobbied for this. But financially, you have to make the decision, can I afford the home? It's not just this idea of buying a house, because you don't actually ever own the home. Can you afford it? Yes, I can squeeze myself financially into buying a house, but then what people find out is like, the roof got to be repaired. I got to replace the refrigerator. I've got to fix the air conditioner. I've got to do maintenance, lawn, and upkeep. All these type of things. And then like I said, property taxes, school taxes, HOA fees. Those things don't. You own a house, you're going to be looking somewhere between $4, $5, $6, depending on the size of your house, $1,000 a year out of your pocket for taxes. And for a lot of people, if you're trying to just make ends meet, just to squeeze yourself into the house, how are you going to make those payments at the end of the year when those come up? So anyway, go ahead, Danny. What's next?
Responding to Sharp's Law, who's giving me a tire critique here. A tire. Yeah. Oh. Evidently, Sharp, stick to law. You can't wear a pattern underneath a pattern. Well, you can if the underneath pattern is smaller. It's the rule of thumb. But have to give you a little grief on that. Yeah, of course. Yeah. So, anyways. Oh, man. So going back, there's a couple things, Lance. I think that talking about home buyer. I mean, that's obviously an easy, low-hanging fruit, easy conversation because it is difficult in many ways. That everybody wants to own a home. Probably not the best thing to do for everyone at any time. But what about right now? Kind of where we are with the markets. PEs is another question. We've talked about this often, but it seems to always come up. And looking at charts and how we should be dictating what to look at, I think that people struggle with the target allocation when valuations where they are. I'm hearing a lot of conversations about, we need to rotate specifically out of AI into more of that value, which is something we've talked about.
And we've done.
But where does it get to for somebody who's trying to follow along? And at what point, I know we've talked about this a couple of weeks ago, in fact, about sector rotation in general, but at what point does somebody kind of back into where their allocation should be? And I think that's difficult too because everybody's different, but it's just a big picture item.
Well, no, look, there's, people are very fixated on allocation, and that's the wrong way to look at it. What you have to look at in terms of your how you structure your allocation is, what are your financial goals? Again, allocation is simply just a function of how much capital preservation do I need, how much volatility risk can I afford, and how much income do I need to make? Because again, as we've talked about before, is that you think about a portfolio and I've got 50% in bonds, 50% in stocks, I can very immediately calculate what my returns are going to be for the year and how much volatility risk I'm going to have in that portfolio. Excuse me, got the hiccups. So, for a lot of people, they go into retirement like, I need to only have like 20% in stocks because, I'm worried about a crash. I'm going to have all my money in fixed income. Well, that's fine, except for the fact that 20% of stocks can't adjust for inflation over time. You just don't have enough exposure to equity growth to adjust for the rate of inflation over time because your dividends and your interest income won't change. It won't adjust for inflation. So if I've got a portfolio that's 80% bonds, 20% stocks, yes, you're very conservative and you're certainly not going to have to worry about any type of market volatility. And if you've got enough money in there that it doesn't matter, right? You don't have to worry about an inflation adjustment because the income, you're making so much income off your bonds because you have such a large portfolio balance, it doesn't matter, then that's fine. But for most people, you've got to build that allocation understanding that, I need to adjust. This is my income run. This is how much money I need every year. So between my bonds and my dividends, so my interest income from my bonds and my dividends, I've got X percentage of income of that total income I need coming in. And then the rest I've got to generate from equity growth. And then I also need that income to adjust for inflation over time. So once you start kind of running that math, you may think that you're an 80-20 person, 80% stocks or 80% bonds, 20% stocks, or 60-40 or 50-50 or whatever, but you may find out that you need, you think you're 40% equity, 60% bonds, but you actually need 50-50, or you actually need 60% stocks and 40% bonds to make your goals work. So again, it's we always kind of approach things backwards. We do it emotionally. We just say, I'm conservative, so I just want to have this allocation to equities. But you may be undermining your future financial outcomes, and this is why financial planning is such an important aspect to your work. Financial plans are your blueprints for building a house. The way most people approach finance and investing is they try to build the house first and then do the blueprints. And typically that doesn't really work out well. And that's why most people wind up not doing well in markets over time, because they don't have a financial foundation, that blueprint to build off of. They're just trying to do it on the assumption that this is going to turn out okay in the end. And that leads to taking on too much risk, losing too much money over time, taking on risk assets that you shouldn't take on. Not having enough conservative assets in your portfolio, not generating the income runs that you need. So again, you have to really start out with, what are my goals, and then build the allocation to fit those goals, not vice versa. Right, Danny?
Yeah, no, I agree. I mean, backing into that and understanding what are those actual goals, we see too often where everybody's benchmarking the index. And that's great, but what if that's not your actual goal? Many people, it's not. So create the hurdle rate, Understand exactly what that rate of return you need to be successful to achieve all those things you're looking to do. And then you can figure out that allocation. Because it's great if we say, hey, market's up 20, we're up. And there's so many people say, market's up 20, I want to be up 22. Great. But at what cost? Because that's fantastic while it's going up, but it's terrible while it's going down. And we know many, many really good money managers, and they don't get that right every time.
Right.
Actually, they don't get that right most of the time. It's very difficult to say, hey, I'm going to be in and then I'm going to get all the way out. But also the flip side of that, it just doesn't work right. The timing, the head fakes, the things we see in the market. I mean, look at the technicals when Lance pulls those up. How many head fakes do you think we've seen over the last, 2 years?
A lot.
A ton. Way more than usual, I would say. And cycles appear that they're happening much quicker. You and Mike talk about sector rotation, going back to that. Those rotations used to happen in months, years sometimes. Now you're seeing it in weeks. So it's a big change.
Yeah. One of the questions was, will the 10% cap on credit cards actually come to fruition? Don't know. There may be some legal challenges to that. It's obviously not good for the credit card companies who depend on that 18, 22%, kind of credit card interest to work. But it's only for, even if it passes, it's only for a year. It's a 10% cap for a year. But I'm sure that if the president tries to just unilaterally use an executive order to impose a 10% cap on credit card interest, it's going to face legal challenges. Again, you're kind of inducing political kind of advantages over the capitalistic system. And there's certain, laws in place to protect the capitalist system. So again, it's not going to come without legal challenges, and immediately, and I wouldn't be surprised if legal challenges aren't already being drafted to be filed if this becomes a thing. So, I think there's a potential that he may, try to do this, but I'm not sure that it actually sticks long term. But even if it does, well, it won't stick long term, but it's only for a year. But even if it's imposed a 10% cap for a year, the consequences of that are going to be negligible. And the reason is that all of a sudden, if I put a 10% cap on my credit cards, consumers have theoretically more money to spend because that 7% on their credit card, if they're paying a 17% interest, they've now got a 7% savings. They're not going to pay down their credit card with that other 7%, right? They're going to go spend it on other stuff in the economy. So we may get a lift to economic growth in that environment to some negligible amount. We're currently at 1.2 trillion, I think, on credit card debt right now as a country. So you may get a negligible boost to economic growth from a 10% cap for 1 year. But again, it's 1 year and then it goes away. So, but again, I'm not even sure if it sticks because I'm sure that Visa and MasterCard and every bank in the country is going to push back on that.
Well, Jamie Dimon alluded yesterday in the earnings call that, hey, they're going to basically throw the kitchen sink at it to make sure that doesn't happen.
Yep.
So I would assume with the ties that they have to the Fed and everything else that it's going to be difficult to get done. But like you said, how many people are actually going to go out and save that money? And, there's still the ability to get out and find 0% for credit card transfer balances. It's not as not as often that you find that right now. As we've seen decline rates increase, we're beginning to see all those other issues. But, people sit on record level of credit card debt. You would think it would help at least short term, but, kind of like when they cut taxes, that first year is great. Everything after that kind of is status quo.
Yeah. Well, again, everything has an immediate one-time effect.
Correct.
If you, and this was always my complaint about sending checks to households. You send checks to a household, that's great, right? So this is the whole problem with UBI. And they've run multiple actual real-time UBI programs in various places to test them, to see, will these things actually work? So these studies have been done on a real-time basis. And what they found out is that UBI is supposed to be universal basic income, UBI. That's supposed to allow people to go get a better education, they don't have to worry about paying bills, so they can go develop a new business, or they can go, improve themselves or get a better job or whatever it is, because they've kind of got some basic bills covered. So they did a couple of tests where they sent like $2,000 or $1,000 a month to houses. And what they found out over time was they did this again, these have been multiple tests globally. The results are almost always identical, is that people don't use that extra income to improve their outcomes.
They spend it.
They just spend it, and they don't improve. They don't go get a better job. They don't improve their education. They don't go start a business. They don't do anything.
Save, invest.
None of that, right? It just gets spent. So the outcome actually worsens over time. And then, as we've talked about before, you send the checks to households. We found this out real time, right? We sent $1,500 checks to households, and then we got 9% inflation. Not a surprise. You shut down the economy. You had no supply. You increase demand by giving people money to spend. You give people money to spend. Where are they going to do it? They're going to spend it. And so you create inflation by having an imbalance of supply and demand. So, whenever you do these incentives, they are always short-term in effect, because whatever I provide a child tax credit to help people out on their child care, because child care is expensive. Yes. And as soon as you provide that child tax credit,
Child care goes up.
Child care goes up. And this is why people are complaining about $35,000 a year in child care, because you keep providing incentives. Stop providing the incentives, these costs will go down. It's always the thing that amazes me is for the smartest people that we have running our government, how they can be so economically stupid when the very basics of the economy come down to supply and demand. Stop affecting demand and you'll fix your problem.
But you're using common sense. They're looking for votes. They're not looking for...
I understand that,
Yeah.
but...
Hey, look what we did. We gave all of these people X amount, and what? Yeah, hey, we'd love to continue to get that. So we're going to continue to vote this way. That's all effectively they're doing in the long term.
I get that, but again, we have problems, and we have a lot of we've got a whole generation of young kids that are coming up that are wanting to vote for socialism because capitalism sucks, because all they're aware of is that everything costs too damn much, right? The rent's too damn high. That's their environment, and that environment has been a function of political policies, not economic decisions.
Well, political policies, but also, listen, I feel like I could start a business and make money in any administration, in any environment, but that has nothing to do with those political policies per se. Now, listen, there's going to be things that are headwinds that you're going to have to navigate.
No, you missed my point. The problem that we have in the economy is a function of political policies.
No,
zero interest
I understand
rates.
that. You're exactly right.
Okay.
But too many people want to fall back on that and blame that.
Well, no, I agree with that.
Go hone up your skills. Go get a new skill set. Go learn. Go figure out an industry, a job, whatever it may be, and go do it and do it well. And you'll do great. Service industry, when we always talk about like neighbors, terrible, right?
Yeah.
Like, man, if you could literally just figure out how to return a call and do actually what you say you're going to do, you'd make a killing.
Yeah. I had this guy email me yesterday. So we have a program that we use. It's a software program we use here to manage our portfolios and those type of things. So he emails me, and because it's time to renew our subscription. So he emails me. He's like, you need to call me so we can renew your subscription. So I immediately called him back, goes to voicemail. And then I emailed him, and it goes to an out-of-office inbox reply. I'm like, why did you just call me if you're not going to answer your phone? I mean, why did you just email me about this if you're not going to answer your phone and everything's going to voicemail? So, but yeah, service.
No, but at the end of the day, I think you're right. I mean, number one, is that even going to be legal if they go out and say, we're going to cap these credit card rates? Probably not. Now you're really disrupting free markets, and you're really disrupting. I get it. Yes, everybody hates the big corporations, and they're out there to get us. But there's a cost of doing business. Guess what? You don't like it, shop somewhere else. Go do something different.
Yeah. One of the questions why is MasterCard dropping on the credit card news? Because they're in the credit card space. Remember, it's kind of always buy the, kind of sell the rumor, buy the news type thing, or buy the news, sell the rumor. But the point is that when you get something like that impacts credit cards in general, or talks about credit cards in general, yes, it's MasterCard and Visa are just processors, but it affects everybody in that chain because people sell baskets of stocks. You have such a large percentage of the market now driven by ETFs. So you get this, I'm going to sell finance because of this credit card news. So instead of selectively selling JP Morgan, Bank of America, credit card companies, the people are actually issuing credit cards, instead of just, selling those. You just sell the whole finance sector all at one time because it's just ETF. So that's just the market that we live in now. But again, just you have to kind of understand that.
Well, I think we're getting towards the end of our questions, Lance.
Yeah. We're also out of time. So
yeah, perfect.
It's been good. Is crony capitalism? It's crony capitalism that is a problem. Yes, that is the problem. Capitalism is not the problem, but crony capitalism is the problem. And this is why stock buyback should be illegal. This is why we should have a whole lot of other regulations in the markets. But we don't, and that's the world that we live in.
Hey, so what do you think about, real quick, what Hegseth and Trump said about defense contractors not being able to do stock buybacks?
Yeah, it lasted for like 27 seconds.
Yeah.
And then
Done.
defense stocks went roaring back off to the moon. So, yeah.
All right.
But the whole reason they said that they shouldn't be able to, they said they wanted to put a limit on buybacks and dividends until the manufacturers, defense manufacturers started producing equipment faster and repairing equipment faster.
Yeah.
So it was, but again, there was no teeth to that argument. That's why defense stocks went like, yeah, down for a day and then roaring back
So
off.
no
to
legal
their time
action,
highs.
just more rhetoric than
it's
anything.
It's just nonsense.
Yeah.
Anyway, all right, that wraps up the show for the day.
Real
Thank you very
Investment
much.
Show pod.
And yes, be sure to go by the website, realinvestmentadvice.com. Get your tickets for this weekend summit. Like I said, we've got a few left. We'd love to see you there. If you've got some time this weekend, come on out. We'll feature breakfast and lunch. It'll be a really good day. Talking a lot about markets, AI, cryptocurrency, you name it. We're going to cover it. Anyway, that's on Saturday, so be sure and come and get by the website, realinvestmentadvice.com. Make sure you're subscribed to our newsletter, daily market commentaries. All that's for free. It's all there for you. All you got to do is take advantage of it. And be sure and like and subscribe to the channel. We certainly appreciate that very much. That thumbs up means a whole lot more than you think to us, because those likes is what drives the algorithms to get us out into the marketplace, gets YouTube to push us. So your like helps us a lot. We certainly appreciate it. So give us that big thumbs up, and we'll see you back here tomorrow with Michael Leibowitz for the next edition of The Real Investment Show.